Welcome back. You're still watching Power Breakfast on CNBC-TV18. Let's take a look at some of the earnings that came out yesterday. IT bellwether TCS kickstarted the earnings season, and it is a miss for the company on all major parameters. In fact, margins have come in at a 9-quarter low for the company. Rima is here with all of the details. Hi, Rima. Good morning. It's not looking like a good set.
Absolutely not. It's an all-round miss reported by TCS this time around. The dollar revenue growth is coming at just 0.6%. In constant currency terms, it's coming at 1.6% when we were expecting a 2.5% growth. And as you pointed out, the EBIT margins have seen a surprise decline this time around. Typically in Q2, margins improve compared to Q1. And for the first time in 6 years, this has not happened. And it's on account of the revenues being lower as well as aggressive hiring. So margins have come down by about 15 basis points on a sequential basis, and that put pressure on the profitability as well. So profits declined by nearly 1%. If you look at the growth rates on a year-on-year basis, growth rate in constant currency terms came in at 8.4%, which means after 4 consecutive quarters of a double-digit growth rate has now moderated to a single digit, and that's the reason why brokerages are now resetting their expectations lower for the full year. So Credit Suisse says the revenue growth expectations from TCS are likely to be reset from 10% to about 7 to 8%. The key reasons why growth has slowed down: one is because digital growth rates have slowed down. Secondly, BFSI as well as retail. We've been talking about the stress IT companies are seeing in BFSI and retail, but for BFSI particularly, the management pointed out weakness in large banks in US and EU in capital markets. The retail recovery, which was expected in Q2, has been pushed forward. And on digital, if you can see, in the last many quarters, the company has been averaging a growth rate of about 40 to 50%, and that slowed down to sub 30%. That said, the silver lining in the numbers is that the order book continues to be pretty good at a 6-quarter high. They won deals worth $6.4 billion, and plus they've announced a special dividend of 40 rupees per share, which means the total payout will be about 45 rupees per share. But I guess then now the street can take away the expectations of a buyback. If you look at what brokerages are reacting, one, growth rates have come down from about 10% down to 8%. Margins are being reset lower by 50 to 100 basis points. EPS estimates have been lowered by 5 to 6%. So now FY21 EPS stands at 93 to 94 rupees per share from 98. Brokerages like Credit Suisse, Kotak have all lowered their target price on TCS.
We have seen actually both increase in deal size as well as deal duration. Okay. So overall that is good from a structural perspective, because neither are we seeing fragmentation nor are deal periods collapsing. The flip side of it is obviously that it will take time for this deal order book to convert. So we have been steadily clocking at more than 1.1, 1.2 times, which over a longer term sets it up nicely for a double-digit growth. But I don't expect any acceleration into Q3, Q4. We would need to be delivering H2 much higher than H1 to get to double digit. So we'll have to wait and see how that folds out.
All right, so that was about TCS management saying that do not expect acceleration in the second quarter and in the third quarter. To catch more of what Mr. Gopinathan has to say, catch the management on CNBC TV18 today at 8:10 and 8:20 a.m. Right, that was about TCS, but we have the other biggie from IT as well reporting numbers, Infosys. Rima, what is the street expecting from Infosys this time around?
Well, after the miss from TCS, it will be very important to see Infosys numbers as well as commentary. Otherwise, the street is going to read this as a sector-wide slowdown. So for Infi, we're actually expecting a steady set of earnings. So dollar revenue growth is seen up by 2.8%. In constant currency terms, it should be a growth of 3.5%, aided by the Stata acquisition. Margins are expected to expand by about 100 basis points, and that's because you don't have the typical wage hikes as well as visa costs. Though for Infosys, there is that partial element of wage hike this quarter, and that could push up profits by about 5.5%. The key will be their FY20 guidance. It's likely to be up by 50 basis points, so 8.5 to 10%. Guidance is likely to now become 9 to 10.5%. But remember, the consensus expectations already stand at 10.5%, which means that even if you get a guidance guidance increase, it's quite likely you will not see a revenue upgrade from the brokerages. But if you don't get a guidance increase, that may actually disappoint the street. On the margins, the guidance is likely to be maintained at 21 to 23%. The key to track will be deal wins given the macro uncertainty, the outlook on BFSI, considering what TCS had to say, and on retail, the attrition for Infosys is very high. Any benefit on account of the cut in corporate tax rates. But remember, compared to TCS, Infi's expectations are more elevated. The stock has been an outperformer. For instance, on a year-to-date basis, it's outperformed the Nifty, it's outperformed its peers, and it's rallied about 20%.
All right, Rima, thanks a lot for running us through all of those expectations from Infosys. We will keep an eye out for those numbers and bring them to you as and when they hit the exchanges. But let's also talk about the other big numbers that were declared yesterday. IndusInd Bank posted results yesterday, and it wasn't a very good quarter for the company either. Loan growth has actually been quite weak. Abhishek is now here to tell us what brokerages have to say about IndusInd Bank's numbers. Abhishek.
Good morning, Pavitra. So as you clearly mentioned, the loan growth is the weakest point that had come in the results of IndusInd Bank. Now, brokerages are saying that the performance is weak, especially on loan growth front and higher credit costs. So across brokerages, they have trimmed down their loan growth estimates anywhere between 5 to 7%, while they have increased the credit cost or NPA provision estimate anywhere between 30 to 50 basis points. Now, operating profit have been trimmed by 5 to 10%, given the fact that the loan growth is on the lower side. However, IndusInd Bank actually benefits from the lower tax rate. So there is not much of a change in the EPS because the transition to lower tax rate meant that the EPS is cut only by 1 to 5%. MOSL has cut PAT estimate anywhere by 10% for FY20. So across brokerages, if you see CLSA, Jefferies, Morgan Stanley, HSBC, Prabhudas Lilladher and Motilal, the target price has been trimmed anywhere between 75 rupees to as high as 200 rupees per share. Back to you.
Abhishek, thanks a lot for that. So we'll watch out for how this pans out in today's trading session as well. Remember, it was down 6% in yesterday's session. But with that, we slip into a quick break, come back and we get you an exclusive conversation with Vedanta's Anil Agarwal on the state of the economy. Stay tuned.